I'm excited to welcome you to this month's Baird Wealth Strategies webinar, and our topic today will focus on Social Security. We're joined today by Sasha Schreiber, a wealth planner here at Baird, as he leads an informative discussion covering eligibility of benefits, how benefits are calculated, benefit claiming strategies, and the current outlook of Social Security. For those of you unfamiliar with Sasha, he is a wealth planner with the wealth planning team here at Baird. He's a CFP professional who works as an extended member of your financial advisors team, providing expertise on challenges affecting high net worth clients. Before I turn the call over to him, I do have a few housekeeping items I'd like to highlight. The first is that for optimal viewing, we do suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner. All participants are in a listen-only mode, but we'd love to hear from you. And so we'll be hosting a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking on the Q&A icon, and please be sure to address your questions to all panelists. Lastly, this presentation is being recorded and will be available along with the slide deck through your Baird financial advisor about a week following today's call. Thank you again for joining us today, and I'll now turn the call over to Sasha. Sasha, the floor is yours.
All right, great. Well, thank you so much, Billy. I appreciate that introduction. I want to thank everybody for spending some time with us this afternoon. We have a fairly packed agenda to cover today. We will be covering the topic of Social Security planning, as Billy had mentioned in the introduction. We're going to be covering quite a few different topics here today. So to get started, I'm going to share with you the agenda so you can take a look at that for yourselves here to see exactly what we will be talking through. Number one, we're going to talk initially about how your benefit is specifically calculated. So a lot of times we get questions around how do I become eligible? How is my specific benefit calculated? We're going to talk a little bit around the formula used by the Social Security Administration in terms of how your benefits are actually calculated. Secondly, we're going to talk a little bit about the tax rules surrounding Social Security benefits. There are tax rules that do apply to Social Security benefits as well, both at the state and the federal level. We're going to look at that in a little bit more detail to see who might be subject to taxation of their benefits. We're going to talk a little bit about timing strategies as well, when to start benefits. That's probably the most common question we are often asked here at Baird is, when do I start my benefit? And there are a lot of different thoughts and considerations that go into the different claiming strategies that clients wish to have. And really, it's not a one size fits all answer. Generally speaking, it's going to be customized based off the client's goals and objectives and what they're looking to get out of their benefits. So we'll talk through that in a little bit more detail. We're also going to talk a little bit about spousal and survivor planning strategies as well. And then lastly, kind of take a look at the outlook for Social Security long-term. So we're going to look at maybe some short-term and long-term modeling scenarios in terms of solvency around Social Security and what that looks like and talk through some of those forecasts. We'll also look at some proposals as well that introduce some solutions to maintain solvency within the program, both short and long-term. And then lastly here, we'll talk about internal tools that we use here, that we utilize at Baird to review claiming strategies with our clients. And I'll cover some of the different tools and programs that we have at our disposal to do that with. All right, so with that all said, let's talk a little bit about how your benefit is more specifically calculated, how you become eligible. So you have to have 40 quarters of earnings to be eligible for Social Security benefits. Okay, and so for this year in 2023, 1 quarter is basically represented by $1,640 of earnings. Okay, so it's tied to specifically earnings. Doesn't necessarily mean you have to work a certain amount of time within the first or the second quarter. It's an earnings component that ties you to those quarters. So as an example, if you had $4,000 earned or income that you generated within 2 months of work during the year, you're going to receive 2 credits essentially for that year. So you can basically front load all your credits if you have uneven income throughout the course of the year. at the front end, if you have all your income earned during that portion of the year, you could really basically receive all your credits on the front end of the year. Little side note here, the number of quarters of coverage do not impact your eventual benefits received. This is just based purely off eligibility requirements. All right, so how is the benefit specifically calculated? So what the Social Security program will look at is the 35 highest earnings years. So for example here, if you've only worked 30 years, and let's say you have 5 $0 years, that could potentially lower your overall benefit. So it's based off the 35 highest working years. If you only have 20 years or you only have 25 years, then it's going to use those 25 years. So one question that I get often is, can my benefits still go up if I'm continuing to work after I retire? And conceivably, yes, if it replaces a lower income earning year, it could potentially still go up. And we'll talk through that again a little bit more in detail in just a moment. The maximum creditable earnings limit for this year, you can see here, is $160,200. That's for 2023. That does adjust annually as well. So that's been lower in previous years prior to 2023. So that's basically the limit under which your payroll taxes would be captured for the purpose of funding Social Security. Earnings over that maximum amount don't impact benefits. And then it's always just a good rule of thumb, if you can, go back and check your earnings history for accuracy, just to ensure that those prior earnings years are accurately calculated for. Quick example here to look at what the maximum benefit would be for 2023, assuming you were at full earned income at those OASDI limits, those wage-based limits in the prior years, and you had all 35 years. The highest benefit payment would be $3,627 a month for 2023. That's at full retirement age, of course, assuming no reductions apply. All right, let's talk a little bit about full retirement age. What does that mean? So when the formula used to calculate benefits is done, it's calculating benefits at your full retirement age. Sometimes you'll hear this referred to as the primary insurance amount. That's the calculation used to determine what your full retirement age benefit is at your respective full retirement age. That is all dependent upon date of birth. So if you were born anytime on or before 1954, your full retirement age is 66. You can see it's 66 and a certain amount of months if you're born between the years of 55 and 59. And then if you're born on 60 or any time later, it's going to be age 67. This is a question that we get quite frequently as well when we start considering when to time our benefits. What reductions would apply if I take my benefits sooner than full retirement age? So you can see here there are two charts, one that ties into an age 66 full retirement age, another breakdown of full retirement age centered around 67, how the specific reductions would apply if you took your benefit any earlier than your full retirement age. So in the 3 years directly preceding your full retirement age, there's an annual decrease of 6.7% per year, of course. And then for any years beyond those first 3 years, again, directly preceding full retirement age, it's a 5% decrease. So it is less of a reduction in some of those earlier years. So you can kind of get an idea or sense of it. If we just look at a quick example here for somebody that has a full retirement age of 67, they decide to take their benefit at 62. You can see the reduction is 30%. So they're only getting 70 cents on the dollar, essentially, in terms of what their overall benefit would be if they took it at that point in time. And keep in mind, these are permanent reductions that do apply, meaning that you are taking a permanent discount on your benefit by taking it any sooner than full retirement age. On the flip side of that scenario, if we look on the other side of the equation, if you were to defer your benefit, which you can do, you can defer your benefit beyond full retirement age all the way up to a maximum collection age of age 70. And in those deferred years, you're receiving 8% benefit growth on your retirement benefits. So again, using the same full retirement age, assuming 67, if you were to wait until age 70, you would receive a 24% growth on your overall benefit between full retirement age and age 70. And you can see it's a sliding scale, 8% per year. These reductions or these additions in the form of this benefit growth, depending upon the timing when you take your benefit, are all prorated on a monthly basis. Okay, so we're looking at this strictly from an annual point of view here, but those benefit reductions and any growth as it relates to these delayed retirement credits are prorated on a monthly basis as well. This is a question that we get, again, quite often. What happens if I continue to work while receiving benefits? And so you can see there is a green icon here and a red icon. So obviously green typically leads us to believe that's a good thing. Red, on the other hand, is not so good. So in this particular case, looking at the green icon first, your benefit can be adjusted post-retirement if, again, one of your earning years replaces one of your lower income earning years. And that's done automatically after year end. Okay, so you can continue to work and post-retirement if you wanted to. And if it's, again, a situation where your income is over and above any prior year that's part of your overall earnings history, then that could be a situation where it replaces that lower income earning year, essentially leading to an increase in your overall benefit. If you're under full retirement age, there is what's called an earnings limit test that does apply. Okay, so this earnings limit test starts with a benchmark of $21,240. Okay, that's the first hurdle. There's actually a second hurdle that we don't mention here. And in the interest of time, probably won't talk through that today. But the first hurdle is $21,240 of annual earnings. So if it's a situation where you start your benefit claim and you're continuing to work and you have earnings over and above that amount, then in that particular case, what would happen is your benefit is essentially reduced $1 for every $2 of earnings over and above that threshold. Okay. Now, eventually, once you reach full retirement age, that goes away. So the Social Security earnings limit test would not apply at full retirement age or beyond. So you can basically earn whatever you want once you reach full retirement age or beyond without having any dollars withheld. I want to highlight or underscore this withheld amount that's mentioned here. Okay, so this isn't a permanent reduction as it would be with taking your Social Security benefits any sooner than full retirement age. This is a withheld amount that the Social Security Administration applies. And we're going to look at an example here in just a second in terms of how those withholding rules would apply under that scenario. All right, so here's the example. Let's say you start taking benefits at age 64, you have a full retirement age of 66. You earn $30,000 during the year, plus you receive $12,000 in Social Security. Now your excess earnings amount, again, that's going to be $30,000 minus the earnings limit test threshold for 2023, which is $21,240, is $8,760. Okay, so your lost benefits are going to be essentially that excess amount divided by 2. Again, remembering that your benefit is going to be reduced for every $2 for every $1 that you earn over and above that amount. Okay, so in this particular case, you can see here the lost benefit, $2, I jumbled that up. Lost benefits are $4,380 in total of lost benefits. So essentially, your net benefit is going to be $7,620. Question we get quite often again as well, okay, how does that work? Is it rateable? Does that apply to every monthly payment that I'm receiving? And the answer there is no, it's not a rateable reduction that would apply to each monthly payment that you're receiving, okay? Basically what happens is the dollars would be withheld on a monthly basis until the full amount required to be withheld is captured. So you can see here, full benefit amounts withheld until the overpayment is covered. The first 5 $1,000 payments would be withheld. So essentially, let's say you started claiming your benefit at the very beginning of the year, just to make the math easy and simple. You started in January, you would basically see your first 5 benefit payments be withheld through May. Okay, so that would be the first $1,000 to $5,000 because they're required to withhold 4,380. Any excess amount, and there would be an excess amount, obviously, in this case, if they're withholding 5,000, the excess amount is going to be, doing the math here, $620 would be refunded at the beginning of the next year. And then essentially the benefits would resume with the 6th payment. Again, starting in June, you would receive your full $1,000 benefit payment. Hopefully that makes sense. Certainly open to questions as well. One thing I didn't mention at the top of the presentation was we will try to reserve about 5 to 10 minutes for some Q&A. Again, we have a fairly tight agenda, fairly tight window here to fit all the content into, but we will do our best to answer any questions that we have towards the end of our presentation. All right, let's talk a little bit about how Social Security is taxed. Okay, generally speaking, low-income taxpayers won't pay tax on Social Security benefits. It is based upon provisional income, and I'll define that a little bit more clearly in the next slide. But basically, here you can get an idea of what the different provisional income brackets are based off your filing status, whether you're married or single. And here you'll see that depending upon which provisional income threshold you fall into, you're going to pay either up to 50% on your Social Security benefits or up to 85% if you're over and above 44,000, if you're married filing jointly, or if you're single and have a provisional income that's over and above $34,000 for the year. If you're under the threshold of 25,000 or 32,000 for single and married filers respectively, then you're not going to pay any tax on your Social Security benefits. Let me define provisional income a little bit more clearly so everybody has an understanding of what that means. So it's essentially all sources of income. Okay? It's going to be investment income, any pension-related income, any distributions from your retirement plans. Tax-exempt interest income is factored into that equation as well. So basically, it's your modified adjusted gross income plus 50% of the actual Social Security benefit received itself. When you apply that formula and then you apply it to these brackets, that will give you some indication, again, to revisit this slide, of what portion of your benefits are going to be considered taxable for that year. Want to point out that there are 9 states that have no income tax. You can see the states here that are outlined within that box. There are 28 states plus the District of Columbia that do not tax benefits. And then we have 13 states that tax benefits in some way, shape, or form. You can see who those states are here within this red shaded box. So I would say refer to that state for more direction on specifically how the Social Security benefits would be taxed respective to those states if you happen to live in one of these states. All right, don't want to spend too much time on this, but it does come up occasionally where we have a client that will be affected by potential reductions in the form of what we call or I should say the Social Security Administration calls the windfall elimination provision and the government pension offset. So I'll explain those a little bit more clearly. As it relates to the windfall elimination provision, to start with that, that is based upon whether you've had any uncovered earnings through an employer at any point during the course of your work history. And if you never paid into Social Security during your time with that employer and you stand to receive a defined benefit pension from them, depending upon what the pension amount is, you could see a reduction applied to your individual benefits that you're eligible for. Okay, so this is specifically tied to your individual benefit. You'll see at the top of the slide, it says you have less than 30 years of substantial earnings. Substantial earnings are defined by the Social Security Administration for this year and for every prior year. You can see in 2023, it's $29,700. Essentially what that means is, if you've had prior years or a current year where you've paid into Social Security, you've had substantial earnings over and above that amount or at that required amount in the year, then that counts as substantial earnings. If you have more than 30 or 30 or more, I should say, then even if you have a defined benefit pension from an employer that maybe had some additional years worked under, the reduction in the form of the windfall elimination provision would not apply if you're drawing benefits under your own individual record. So those are some of the key points as it relates to the windfall elimination provision. There's a second provision that's a little bit more punitive to that. We'll talk about the government pension offset in just a second, but just to give you a quick example of the windfall elimination provision, as you can see it here, again, primary insurance amount still drives the survivor benefit calculation. This applies to your own benefit, as I mentioned earlier, okay? And it's based off the average index monthly earnings calculation that's performed to determine your full retirement age benefit, your primary insurance amount. This is typically how the primary insurance amount calculation is specifically calculated. So you can see that here. The first $1,115 of average monthly earnings is multiplied by 90%. The next hurdle is $6,721 of earnings, which would be multiplied by 32%, and any remaining earnings over and above that would be multiplied by 15%. Now, when the windfall elimination provision applies, and again, it's all dependent upon how many years of substantial earnings you would have, then this first component of the calculation is impacted. So normally, again, the first $1,115 of monthly earnings is multiplied by 90%. Again, depending upon how many years of substantial earnings you have, you can see that percentage is going to be potentially much lower. Again, if you have 20 or less, it would be 40%. And that's really where the impact would apply as it relates to your pension amount that you're receiving. So the one thing to point out with this formula can be a little bit more complex to understand, is that there is a cap to it, meaning that the max reduction for someone that reaches age 62 in 2023 is $557.50 per month. So it can't be any more than that. Okay, so if you have a benefit and you kind of top out, you would top out at $557.50 months. Can't exceed a reduction any more than that. All right, the other reduction that might apply is the government pension offset. This does not apply under someone's individual benefit record. This would apply to spousal and survivor benefits. As I mentioned, it's a little bit more punitive than the windfall elimination provision. The reduction amount is 2/3 of whatever monthly pension amount you stand to receive from that employer through which you had uncovered earnings. Here's a quick example of that. If the monthly pension amount that you're receiving is $1,000 a month, and using a quick 2/3 calculation, the Social Security reduction that would apply is $667. So if you have a significant enough defined benefit pension that you stand to receive from an employer, again, through which you didn't pay any Social Security tax through, then in that case, your benefit can be eliminated altogether. But again, this only applies to a spousal benefit and or a survivor benefit. So it's strictly tied to benefits claimed on someone else's record. All right, so some different factors to consider when starting benefits. As I mentioned at the outset, this is one of the most common questions that we receive from clients. When do I begin my benefits? What makes the most sense? And again, it's very subjective because it really differs from client to client as I have those conversations. These are some just general points of consideration to take into account when you're going through that decision-making process. So number one, we talked about this earlier. You can look at deferring your Social Security benefits beyond full retirement age as an alternative investment return, since you stand to receive 8% benefit growth year over year beyond that point in time. Another consideration would be legacy goals. So if you have, a client that if you're somebody that's interested in substantial legacy goals and you want to ensure that your assets are available to future heirs or maybe charitable institutions that you wish to fund at the time of your passing, then maybe the idea is to start your Social Security benefits a little bit sooner so that you can preserve those assets that would otherwise be used as part of your retirement funding longer term and earmark those specifically for future heirs or any charitable institutions that you may want to donate to it at some point in time. So it can be looked at that way as well. Continuing to work, I know we talked a little bit about this already and how Social Security can be potentially reduced by employment income. So keep that in mind. The general rule of thumb in most cases, which we'll find is it makes sense to wait, take your benefit until you actually separate from service with the employer so that there's no impact in the form of withholding as it applies to your benefits. Especially if you have a significant amount of income and you're well above that $21,230 earnings limit test hurdle. In those cases, it really makes sense to wait because you could have the majority of your benefit withheld, if not all of it, if you have a significant enough income. Another thing that sometimes comes up during the course of conversation are health considerations. When you take Social Security earlier, sometimes that's the idea, so you can get a little bit more beneficial enjoyment out of those benefits while you expect to be healthier, and you can spend the extra income. Maybe you're traveling more in those earlier years. So the idea there might be to take it a little bit sooner again, while you can get some of that beneficial enjoyment out of those benefits. Another key consideration here would be maximizing the spousal survivor benefit. And you'll see this oftentimes where you have, a spouse, a working spouse that has the higher of the two benefits. Maybe you have a non-working spouse and the working spouse that has the higher of the two decides to defer their benefit as long as they can so that they maximize the spousal step up for the surviving spouse longer term if they were to predecease their non-working spouse. So we see that as well quite often. Medicare implications, keep in mind automatic enrollment to Medicare Part A occurs at age 65 when you're already on Social Security. So there are some HSA considerations around that to keep in your back pocket, because what happens at that point in time, once you're automatically enrolled in Part A, you can no longer make contributions to your HSA at that point in time. So that might be an issue for some clients that may have a high deductible health plan through their employer if they're still working and they enrolled in Social Security early and they want to continue to make contributions to their HSA. So again, just something to keep in mind there. You'll see the future of Social Security, and we're going to talk a little bit more about Social Security solvency and look at some of that in greater detail, again, towards the end of the presentation. But for some folks, they'll just simply say, I want to take it when I can get it, because we're really uncertain about, the future of the Social Security program. We have a lot of, questions and security issues around whether or not we're actually going to receive 100% of the benefits that we're eligible to get. And so many clients kind of take the position of, well, I'm just going to go ahead and take it while I can get it. We'll talk a little bit around the solvency issue again going forward. Lastly, this is the great unknown, right? Life expectancy. Nobody knows when they're going to pass. It's not always easy for us to talk about our own mortality, but we try to put together reports here, and I'll talk through some of the different tools and programs we offer here at Baird that look at different mortality assumptions to kind of get an understanding of timing strategies and what makes the most sense. Again, based off each and every client scenario. Here's a quick example. Worker retires at the end of 23 at age 62. The retiree could receive Social Security benefits at full retirement age, 67 of $2,000 a month. Again, that's their primary insurance amount, the calculation we talked through in more detail earlier. If they took it at 62, there would be a benefit reduction to the tune of 30%. So they would receive $1,400 if they took it at 62. On the flip side of that, again, if you decide to defer beyond full retirement age, earning those delayed retirement credits each and every year, you're getting that 8% annual benefit growth. If you year over year, if you wait to 70, it's 24%. So that would increase your benefit to $2,480. To expand on that example, you can see that this is the very same example we just looked at. This is assuming a cost of living adjustment of 2.4% year over year. Obviously, it's been much higher than that in the last 2 years as a result of inflation. But this chart kind of gives you an idea, looking at starting ages here, using that same example, 62, full retirement age, age 70. Where do the break-even points lie, right? And so you can see here, looking at these different shaded color bar graphs here, you can see that the break-even point for starting at 67 and age 70 is right around 80. 62 is not that far behind when you compare against, those higher claiming ages. So that's the break-even point. And it kind of gives you some sense of where, where those break-even points lie. And our Social Security reports actually do look at break-evens as well to determine, what age you would have to live to or beyond to ensure that, waiting or deferring to a later age makes sense as you're having some of those break-even point discussions with your advisor. All right, let's take a look at spousal planning strategies here around Social Security benefits. So one worker can provide provide benefits to many individuals. Obviously themselves under their own individual record, a spouse, surviving spouse, minor children, an ex-spouse, surviving ex-spouse, and even parents, dependent parents. So you can see that there are multiple beneficiaries that can stand to receive benefits under one worker's record. As it relates to the spouse is eligible for the larger of the two, benefits based on their own work history or a 50% benefit based on the spouse's work history, again, also known as the spousal benefit. That's based off the spouse's primary insurance amount. You have to be married, generally speaking, at least 1 year before collecting spousal benefits. And you can't claim spousal benefit. This is important and sometimes gets overlooked, and it's a question we get often. You can't claim a spousal benefit until the working spouse files for benefits as well. Okay, so the working spouse has to file before the other spouse can claim a spousal benefit. Let's look at benefits for a surviving spouse. Our surviving spouse is also eligible for the larger of the two benefits, again, based on their own work history, or 100% of the benefit based on a deceased spouse's work history. The maximum benefit obviously would be received at full retirement age. If you had a spouse that is attempting to claim a surviving spouse benefit any earlier than full retirement age, then again, those reductions would apply. The reduced benefit can begin as early as age 60. Okay, so I think if you remember, we talked a little bit about individual and spousal benefits. Those begin at 62. If it's a surviving spouse that's attempting to make a claim, they can go ahead and make that claim as early as 60 under a widower's benefit. It's even earlier than that if the spouse making that claim is disabled. It would be 50, age 50 or older in that case. What are the requirements for a surviving spouse benefit? You must be married at least 9 months, except in the case of an accident. They would waive it in that situation. And the survivor must not have been remarried before age 60. So that's another important caveat as part of these requirements. If you get remarried anytime before age 60, then you lose the ability to claim off the surviving spouse benefit off your previous spouse's record. There is an exception to that, and you'll see in parentheses here, unless that second marriage ends. Then in that case, if you were remarried between the ages of 50 and 59, and that marriage ends, then you would have the ability to go back and make that surviving spouse claim on the first spouse that you were married to that passed away. All right, we're going to look again at benefits for the ex-spouse here. Actually, this is the first time we're looking at. So benefits for ex-spouse, we looked at spousal benefits earlier. It's really the same rules that apply. Here are the different requirements that are required to qualify for an ex-spouse benefit. The marriage must have lasted at least 10 years. You need to have been divorced at least 2 years. That is waived in certain situations. As you can see here, if the worker was already receiving benefits at the time of the divorce, maybe that divorce happened later in life and the worker was already receiving benefits at that time, then they would waive that. But otherwise, you would ordinarily have to wait at least 2 years. The person receiving the divorced spouse benefit also has to be unmarried. Now, you could have remarried and redivorced. And if that does happen, if you have a case where that does happen, you have maybe multiple marriages that have ended, then you would actually have the ability, or a worker would have the ability to go back or not a worker, but a spouse, an ex-spouse would have the ability to go back and claim benefits off those previous spouses' records. I think you can do that up to 4 different spouses if you were married that many times. The working spouse must be eligible to receive benefits. So this is, again, a common question that we get quite often as it relates to ex-spousal benefits. Does the working spouse need to be collecting benefits in order for the ex-spouse to make a claim for an ex-spousal benefit? No, they don't. They just need to be eligible to receive benefits, meaning that they have to be at least age 62 in order for that to occur. And that just, so doesn't have to begin taking benefits. All right. As I mentioned earlier, multiple ex-spouses can claim on a single worker. You're married multiple times. Any benefits paid to an ex-spouse don't affect the worker, the current spouse, or any other exes. Okay, so it won't impact their benefits directly. Divorced spouse benefits would again stop upon remarriage. All right, let's talk a little bit more about benefits for surviving ex-spouse. Okay, so if again, you're looking to make a claim on an ex-spouse that has passed away, here are some of the different rules that would apply. Okay, survivor benefits are essentially the same. For the current spouse, you have to have been married for at least 10 years. Reduced survivor benefits can start as early as age 60, and you can't get remarried before age 60. Guys, you can't get remarried before age 60. Unless the new marriage also ended prior to age 60. So again, there's always some exceptions to the rule in this particular case. Any remarriage after 60 would not prevent you from making a claim for a surviving ex-spouse, or on their record, I should say, on a surviving ex-spouse's record. I don't want to spend too much time on this restricted application because this is a scenario that really only applies to a very small window of people at this point, but I'll cover it very quickly. For those that were born on or before January 1st of 1954 and are older than full retirement age, and maybe let's say they haven't yet started their claim, which I think most folks that meet those requirements probably have started their claim already at this point, but maybe for some that were planning on deferring to age 70 and haven't started their claim, you have the ability to file a restricted application, meaning you're restricting the scope of that application to a spousal benefit. So if you're married, you can actually collect spousal benefits and continue to defer under your own record, and grow your individual benefit further until age 70. But again, that population of individuals is narrowing very quickly. This will be expired come January 1st of 2024 next year, when those that are born, on or before that date are obviously age 70 at that point. But just something to keep in mind. I don't know that it would make much sense if somebody does fit into that category now to even do that because of the amount of time you have to wait just to process the application if you did apply for a spousal benefit under a restricted application. So I wouldn't put too much weight on that. All right, we're going to continue to talk a little bit about survivor planning. Here's some of the basics. Benefit is based, surviving spouse is eligible for the larger of a benefit based on their own work history, or 100% of the benefit based on the decedent spouse's work history. You can see the age and filing status of the deceased at the time of death determines the base benefit amount. That's really important to remember. There's different scenarios that could play out there that actually determine the surviving benefit amount that the surviving spouse is eligible for. It would be reduced as well if the survivor begins to receive that benefit prior to full retirement age. And so we talked about that earlier. There is actually a separate full retirement age scale that applies to survivor benefits that differs from individual benefits, but they're fairly close in line with one another. But if you did take it any sooner than full retirement age, under that calendar, then you could see a permanent reduction apply. But again, as we talked about earlier, you can start that as early as age 60. And again, it would be subject to the earnings limit test rule if you're still working at that point in time as well. So earnings limit test does apply not only to individual benefits, but to spousal and survivor benefits as well, if you're under full retirement age. This is a situation or scenario where you can potentially file a restricted application. So a lot of times what you'll see here is, the survivor can begin one benefit and then ultimately switch to the other benefit later. What that means is, usually you'll see what we call kind of a low to high strategy here. You'll take the lowest of the two benefits first, allow the larger of the two benefits to continue to maximize. So you receive the highest amount while you're drawing on the lower of the two benefits initially. So a lot of times that might mean taking your survivor benefit at age 60. So you're generating some income at that point. and letting that continue all the way up until you're eligible to switch over to your individual benefit under your own record, where you continue to defer to a later age, whether that's full retirement age or even beyond, where you're receiving those delayed retirement credits all the way up to age 70. So that's typically what we'll see there. Now, sometimes it might also happen in reverse, where you take the individual benefit first. Let's say you didn't have a lot of earnings years and your individual benefit, although you're eligible, is relatively low. You can start the individual benefit first and then ultimately switch over to the survivor benefit at age 67. At that point where you're maximizing your survivor benefit. You don't earn delayed retirement credits on a survivor benefit as you would under your own individual benefit record. And I think this next slide just more or less talks to, I think, what I just mentioned, claiming the lower benefit as early as possible. Again, you can take it as early as age 60, if it's your own benefit as early as age 62. Again, keeping in mind that working could potentially reduce or eliminate your Social Security benefits as well. You can switch to the higher benefit as late as possible. Whether that's full retirement age under the survivor calendar or age 70 again under your own individual record. All right, so that gets us to the outlook for Social Security. So I wanted to spend a little bit of time here. I know we're running a little bit short on time, so I'll try to move through these a little bit more quickly if I can. But each year, there's a trustees report that's produced by the Social Security Trust Fund or the Social Security Administration that gives us an outlook around the Social Security Trust Fund. So there's two separate trust funds. There's the OASI, the Old Age and Survivors Income Trust, that is geared towards funding retirement benefits. And then there's a DI, Disability Income Trust, that's used for disability claims to pay those benefits. Okay, we're going to look at two projections here, short range, long range. Short range covers about 10 years and the long range about 75 years. And you're going to see your red and your green here, which many of you might have already guessed it would look this way. The retirement fund is where the larger concern lies. Okay, so both short-term and long-term. You can see here that retirement benefits paid are projected to exceed the total tax and investment income every year through 2032, starting now. So that surplus fund is basically shrinking year over year. So by the end of 2032, the fund is projected to hold just 7% of expected benefits in 2033. This year, you can see there, a small little radio button holds 220% of 2023 benefits at the beginning of this year. The opposite is really true when it comes to disability. You can see the tax revenue projected is expected to continue exceeding disability benefits. So the reserves are continuing to grow. By the end of 2032, the fund will actually hold 194% of projected 2033 benefits. So the disability fund's in good shape. The concern or the issue really lies solely around the retirement fund more specifically. I'm going to skip over this graph just for the time being. It really just kind of captures what we talked about in the prior slide for the most part. In the interest of time, I'm going to move through that one. There are some different solutions that the Board of Trustees have proposed. So you can kind of see that here to ensure solvency not only now but for the next 75 years, and that would require increasing the tax rate to 3.44%. That would be up to 15.84%. So right now we're at 12.4%. So the idea there is, again, increasing that rate in such a way where, we're creating for solvency longer term. Or reducing all benefits by 21.3% today. And that's all benefits. Or reducing benefits for those that started their claim in 2021 only by 25.4%. I'm not sure that those that claimed in 2021 would say only, but 25.4%. Okay, so those that were receiving benefits that started their claim prior to 2021 would be grandfathered in. They would still continue to receive, their full expected retirement benefits. Now, this is really where you want to pay attention. So, if procrastination persists and we don't make any changes to the program, if we continue to wait until 2034, you can see how some of these proposals would differ in that case. Tax rate would have to be increased. So we would increase the tax rate by 4.15% to 16.55%. And then the other option would be reducing all benefits by 25.2%. So you can see that waiting is not the ideal solution here. It's coming up with a solution earlier, hopefully, than later. All right. I'm going to move through this slide a little bit more quickly. Here are some additional proposed solutions that are on the table. You can see here, these don't really have much of an impact on the trust, but I just want to point some of these out. The one maybe the most impactful proposal here is the first one beginning with 2024, reducing the cost of living adjustments by 1%. That only adds 5 more years of solvency. Really not a lot of game-changing proposals here within this specific slide. Now on the next slide, as we continue looking at different proposed solutions, this is where you begin to see a little bit more in the way of impact from some of these different solutions that have been put on the table. You can see the first one here, apply a new 6.2% tax on investment income in 2024. It's kind of similar to the 3.8% net investment income tax. But again, that only creates an additional 4 years in terms of duration. The next two probably have the most impact, and this has to do with the earnings cap. We talked a little bit about that earlier. The OASDI limits, the amount of income that caps out each and every year. Again, this year it's around $160,000, but removing that entirely and subjecting all earnings to 12.4% payroll tax with no credit towards benefits. So that's the key ingredient here. That second part, even though you're capturing more in the way of collecting to fund the trust, those additional earnings being collected, if you were to remove the cap, are actually not providing any crediting towards your benefit, meaning it's not increasing your benefits. The second one here at the very bottom would be to subject earnings above $250,000 to 12.4% in payroll tax, again, with no credit applying towards benefits. So that's more of that donut hole type strategy, where you continue to collect up to the current OASDI limits, the wage-based limits, which again is about 160,000, and then you would have a donut hole until you reach that earnings level of 250,000 and above, where that payroll tax would kick back in essentially, and that would create a projected 28 years of additional solvency to the trust. All right, so comparing your benefit options, again, I would certainly encourage you to reach out to your Baird financial advisor, who can help you evaluate a variety of these different claiming strategies. And we can certainly work together to identify the best claiming strategies, again, based off your specific goals, your specific requirements, your desires longer term, and what fits best with your financial plan. So certainly seek their counsel as it relates to these claiming strategies when possible. Here are a few of the different reporting tools that we have available within Baird. So we have a standalone Social Security analysis or tool that we use to look at maximizing cumulative benefits. We can look at that a variety of different ways. We can look at it from an individual standpoint. We can look at it for married individuals. We can also look at it in consideration of spousal benefits and survivorship benefits as well. So there's a number of different ways we can analyze those different claiming strategies. Again, I I would ask that you reach out to your financial advisor for more detailed information on how you can get started with that. We do have additional tools above and beyond that as well. We would always recommend that you have a financial plan that integrates many of these different claiming strategies so that we know that it coordinates well and we identify any potential gaps with your financial plan if any do exist. So always good to ensure that we're looking at Social Security benefit planning in coordination with all of your other areas of your financial plan. This is just kind of a quick look or sneak peek of, again, our financial planning software and how it integrates Social Security timing or claiming strategies as well, looks at break-even points, probability of success, and analyzes cumulative benefits, similar to the standalone report I mentioned earlier. Here's some additional helpful resources. If you have any other questions that maybe we haven't had a chance to answer, I know I'm running really short on time and I apologize for that. But you can see there are some good resources out there. Obviously, the Social Security Administration's website. You can go there directly to get any information on Social Security. If you want to look at what you stand to receive from a benefits perspective or take a look at your earnings history, you can draw all that information from the website directly. There's a really good tax piece, IRS publication 554, which is a tax guide for seniors, also available on the IRS's website. That's www.irs.gov. And then lastly, a resource I really like is the AARP, Social Security Resource Center. It's a great resource site for any unique Social Security type planning questions or concerns that you might have. They have a really expanded search function there where you can get a lot of good, useful information. Here is a quick snapshot of our regional planners. We work, again, hand in hand with your financial advisor as it relates to these claiming strategies. So again, I ask that you reach out directly to your advisor who may utilize our resources here as well and integrate with us to produce a Social Security claiming strategies report for you to review. That's all I have. I know we don't have much time left. Again, I apologize for going right up against 2 o'clock. I want to thank you all for joining us today. I'll turn it back to Bailey here. If we do have time for some Q&A, we can certainly try to cover as much of that as we can. If not, I would say, direct any questions to your financial advisor and to seek their counsel around some of these different Social Security claiming scenarios and strategies. And if we need to partner with them, we can certainly do that as well. So with that, I will turn it back over to you, Bailey.
Thanks, Sasha. Unfortunately, due to this being such a technical topic, we have run a bit short on time. However, I would highly encourage everyone with any questions you may have that weren't answered by today's presentation to reach out to your Baird advisor or contact who invited you to this presentation today. As a reminder, if you'd like to see this presentation or share it with a friend, family member, or colleague, we did record this session and it will be made available in about 1 week, either through your Baird financial advisor or via bairdwealth.com. And as I said, please don't hesitate to reach out to your contact at Baird who will connect you with the appropriate resource to get your question answered. Thank you, everyone, and enjoy the rest of your afternoon.